A $22 million company, sells canned tuna and chocolate, has been listed for 20 years, and nobody talks about it. But here's what caught my attention. The stock just rallied nearly 47% in 12 months. It trades at 7 times earnings, 58 cents on the dollar of book value, and there are almost zero analysts covering it. Is this a hidden gem or a value trap? Let's find out. Welcome back to JC Project Freedom, and today we're doing a full institutional-grade deep dive on Hosen Group, ticker 5 electron volts on the SGX Catalyst board. I've gone through 6 years of annual reports, built a full DCF, run a reverse DCF, and applied my JC Fund framework. By the end of this video, you'll know exactly what this business is worth, what the risks are, and whether it makes the cut for the JC Fund. Let's get into it. So what does Hosen actually do? At its core, Hosen is a packaged food distributor and house brand manufacturer. It does 2 things. First, house brands, which is about 84% of revenue. Hosen owns a Hosen brand on canned tuna, sardines, mackerel, canned fruits, canned vegetables, and chocolate products. These products are made by contract factories, mostly in Southeast Asia, but Hosen owns the recipe, the packaging, and the brand. Because they own the whole supply chain from brand to shelf, they capture the full gross margin. No middleman taking a cut. Second, non-house brand distribution, about 16% of revenue. This is more traditional. They import and wholesale other brands' canned goods into Singapore and Malaysia, lower margin, but it fills their trucks, keeps their warehouse running, and maintains shelf relationships with the supermarkets. The third segment to watch, Hosen Chocolate SDN BHD. This is a wholly owned factory in Senai, Johor, Malaysia, that manufactures compound chocolate, tablets, molded figures, coatings, for both retail shelves and directly for hotels, bakeries, and chocolatiers. And this segment is central to their growth story, which we'll come back to. Geography. Singapore is their biggest market at 43% of revenue. Malaysia is 32%, and about 25% goes to export markets. Brunei, Hong Kong, the Middle East. So in simple terms, Hosen buys raw ingredients and manufactured goods cheaply in Malaysia and China, brands them, and sells them to value-conscious consumers across Southeast Asia. The SGD is their working currency, and they source in weaker currencies, and that currency dynamic has been a huge tailwind lately. Now, let's look at the numbers. 6 years of data. Revenue is range-bound between $67 million and $74 million. This is a flat revenue business. There's no getting around it. For the past decade, top-line growth has been essentially zero. COVID gave them a small pantry stocking boost in FI 2020, but by FI 2023 revenue was back at FI 2019 levels. If you're looking for a high-growth compounding story, this isn't it. But here's the thing, and this is the entire thesis. Look at the gross margin. FI 2020, 20.5%. FI 2022, 22.1%. FI 2024, 23.5%. FI 2025, 25.1%. That's 460 basis points of gross margin expansion over 5 years, with zero revenue growth. And because this is a relatively small cost base, SG&A is fairly fixed, that gross margin expansion falls almost entirely to the bottom line. Net profit, FI 2019, a loss of $0.94 million. FI 2020, $2.92 million, COVID pantry stocking boost. FI 2022, FI 2023, back down to $1 million range. FI 2024, $1.97 million. FI 2025, $3.20 million, a 62% jump. So this is not a revenue growth story. This is a margin expansion story. Every 100 basis points of gross margin improvement is worth roughly $700,000 of additional gross profit. When that flows through to net profit, EPS moves significantly. The question for the investment case is this margin expansion structural and durable, or is it a temporary currency tailwind that reverses? Let's talk about the FI 2025 results in detail, because this is what drove the stock's recent re-rating. Revenue, $69.56 million, down 4.4% from FI 2024. On the surface, that looks bad, But there's a specific reason. In FI 2024, one single customer accounted for 10.7% of total revenue. That's about $7.8 million from one account. In FI 2025, that customer was gone. No single customer exceeded 10%. Management's explanation is that they diversified deliberately, but they haven't been explicit about whether this was voluntary or a loss account. That's one of the questions I'd ask the CEO. Net profit, $3.20 million, up 62%. Despite lower revenue, profits nearly doubled. That's pure margin story. Gross margin, 25.08%, the best in at least 6 years. EPS, 0.99 cents per share, highest in 5+ years. Operating cash flow, $6.61 million. Here's something important. OCF was more than double net profit. That's a green flag in forensic accounting. When operating cash flow consistently exceeds net profit, it tells you the profits are backed by real cash flows, not accounting tricks, not revenue recognition games. This is a good sign. Balance sheet, near zero net debt. Cash of $7.74 million versus borrowings of $8.11 million. Net debt is only about $400,000. Compare that to $9.2 million net debt just 3 years ago in FI 2022. They paid down almost the entire debt load from operating cash flow. The balance sheet is clean. One important caveat. That $3.20 million net profit includes a $359,000 deferred tax asset recognition. That's a one-time accounting benefit. Clean underlying profit is closer to $2.84 million. Keep that number in mind when you're doing forward modeling. Dividend, 0.20 cents per share maintained. This is payable in May 2026. And at the current share price of $0.069, that's a 2.9% yield. But, and this is critical, the dividend has been flat at 0.20 cents since at least FI 2020. 5 years, zero dividend growth. We'll come back to why that matters for the Engine A, the dividend growth analysis. The stock is up about 47% in 12 months. Why? Catalyst 1, the FI 2025 earnings shock. The market was pricing in mediocrity. 62% profit growth is not what people expected from a company that has been flat for a decade. When the results came out in February 2026, there was genuine surprise. That surprise re-rated the stock. Catalyst 2, gross margin breakout. 25.1% gross margin confirmed the structural story. This wasn't a one-year fluke. The 5-year upward trend in gross margins told investors this is real. Not luck, not a temporary blip. Catalyst 3, balance sheet repair. When a company goes from $9 million net debt to near zero in 3 years, the financial risk premium on the stock compresses. Investors no longer need to worry about refinancing risk or covenant breaches. That directly improves the quality of earnings. Catalyst 4, the chocolate factory. In FI 2024, Hosen signed an agreement to buy factory land in Johor and committed $4.7 million to build a new chocolate manufacturing facility. By FI 2025, $3.19 million is already capitalized as construction in progress. This is the first visible growth CAPEX story in years. Even before a single dollar in new revenue, the market often gives a premium for a plausible growth narrative. Catalyst 5, SGD currency tailwind. Singapore dollar strength against the Malaysian ringgit and Chinese yuan directly reduces the cost of goods. Hosen sources and manufactures in those weaker currencies, but earns in SGD. This is a macro tailwind that has been blowing strongly in 2024 to 2026. Catalyst 6, CEO succession completed. The founder Lim Hai Chiok stepped back from CEO in May 2024, handing the role to his son Daniel Lim. For a family-controlled microcap, a clean succession removes uncertainty about what happens when a founder eventually steps back. Clean successions tend to reduce governance risk premiums over time. Does Hosen have a moat? Let me be honest with you. The short answer, narrow moat, not wide. Here's how I score the 5 moat types. Switching costs, 2 out of 5, low medium. Retailers have 20-year relationships with Hosen. Changing suppliers requires a new listing process, potential shelf disruption, and out-of-stock risk. But these switching costs are modest. A determined competitor with better pricing or terms could displace Hosen products. Cost advantage: 2.5 out of 5 medium. The SGD-based operating structure with MYR and CNY manufacturing costs creates a genuine competitive advantage. Their multi-decade supplier relationships give modest procurement advantages. But any sufficiently large competitor with similar geographic exposure would have the same advantage. Brand and intangibles: 2 out of 5 low-medium. The Hosen brand has real shelf recognition in Singapore and Malaysia, but it's a value brand. It cannot raise prices meaningfully above IM brand without losing volume. This is not brand power in the Coca-Cola sense. Network effects: 0 out of 5. There are no network effects in canned food distribution. Efficient scale: 1.5 out of 5 low. Hosen is just large enough to occupy the value tier shelf in most supermarkets, not large enough to have scale advantages over bigger FMCG players. Overall verdict: narrow moat. The business has sustainable competitive advantages, shelf relationships, SGD cost advantage, brand recognition, but they're not fortress level. The moat is sufficient to sustain the current business at its existing scale. It's not sufficient to drive meaningful market share gains.
Let me quickly walk you through the supply chain, because understanding where Hosen sits helps you understand where the value is created. Upstream, raw materials. Canned seafood ingredients come primarily from Thai Union Group in Thailand, the world's largest tuna canner. Cocoa inputs for chocolate come from ADM Cocoa and Barry Callebaut. Vegetable oils come from Wilmar International, which is SGX listed. Steel cans come from manufacturers in China and Malaysia. Manufacturing tier. For canned goods, Hosen uses third-party contract canneries. They don't own these. For chocolate, they own Hosen Chocolate SDN BHD in Sinai, Johor. New factory under construction next door. Hosen Group, the brand owner and distributor. This is where the value lives. Hosen owns the brand, owns the recipe, controls the distribution relationships. 3 key subsidiaries: Hosen Food in Singapore, Hosen Food Malaysia, and Hosen Worldwide for export. Retail channels. In Singapore, NTUC Fairprice, Sheng Siang, cold storage. In Malaysia, Aeon, Lotus's formerly Tesco, Maidan. For export, third-party agents in Brunei, Hong Kong, and the Middle East. End customer: value tier households across Southeast Asia. And for chocolate, professional chefs, hotels, bakeries. The key insight from this map: Hosen is an asset-light brand owner sitting between commodity inputs and retail shelves. The margin is created between the factory gate and the consumer's shopping trolley. Now, let's see how Hosen is valued relative to its peers. I've built a comparables table across 7 companies. Food Empire's $700 million market cap, 9.8x EV/EBIT, 13.7x P/E, 3.2% yield. This is probably Hosen's closest listed peer in Singapore. Packaged food, dividend payer, regional distribution. Trades at nearly double Hosen's EV/EBIT. Sheng Siang, $1.8 billion market cap, 22x EV/EBIT, 23x P/E. This is a supermarket retailer, a different business, but included for context. Thai Union, $1.8 billion market cap, 11x EV/EBIT. This is the world's largest tuna processor. They're literally upstream from Hosen. 11x EV/EBIT versus Hosen's 5.6x. Del Monte Pacific, $150 million market cap, 8x EV/EBIT. This is probably the most direct operational comparable: canned seafood, canned fruit, Asian distribution focus. And they trade at 8x EV/EBIT. Hosen, 5.6x EV/EBIT. That's roughly 30% below even the cheapest comparable. The discount comes from 3 things: microcap illiquidity. Most institutions simply can't own a $22 million market cap stock, family governance concerns, and the decade of flat revenue growth. But here's the interesting thing: if you close even one of those discount factors, if the stock gets discovered, or if the dividend starts growing, or if the chocolate factory proves the growth story, the multiple can re-rate toward 8-10x EV/EBIT. That implies a stock price of 9 cents to 11 cents, a 30 to 60% upside from here. Let me walk you through my EPS estimates from FY 2026 to FY 2030. The key assumption: revenue grows modestly at 2 to 4% CAGR. This reflects stable distribution volumes and modest export expansion, with an incremental boost from the chocolate factory starting FY 2027. But the bigger driver is gross margin expanding from 25.1% today toward 27% by FY 2030. Every 1 percentage point of gross margin improvement is worth about 0.18 cents per share of EPS. That's the lever. Bear case: if the SGD weakens and gross margins revert to around 23%, EPS stays in the 0.80 to 1.00 cents range. Bull case: if gross margins reach 27% by FY 2027 and the chocolate factory adds meaningful revenue, EPS could reach 1.40 to 1.60 cents by FY 2028, 2 years ahead of the base case. No share dilution assumed. Hosen has no options program. Now, let's talk about what could go wrong. This is the forensic accounting section. Flag 1. High family governance risk. This is the biggest concern for minority shareholders. For members of the Lim family, the founder, his wife, and 2 sons hold paid executive roles in the company. Who independently sets their compensation? The independent directors, in theory. But in a family-controlled microcap, with a founder patriarch still in the building, the governance question is real. If the family decides to pay itself more, it comes out of your returns as a minority shareholder. Flag 2, medium. FY 2025 net profit is overstated by 359,000 Singapore dollars. The reported $3.20 million net profit includes a deferred tax asset recognition. This is a perfectly legal accounting entry, but it's one time. Your real forward base is $2.84 million. That's still excellent, but make sure you're modeling from the right number. Flag 3, medium. The 10.7% customer disappeared. We don't know if this was voluntary diversification or a lost account. This is a genuine information gap. A lost account of that size would suggest competitive pressure in their distribution business that management hasn't disclosed. Flag 4, medium. Chocolate factory capex risk. 4.7 million Singapore dollars is going into a segment that has historically been loss-making. If the new factory doesn't generate returns, if chocolate revenues don't materialize, Hosen will have to impair that asset. Watch the FY 2027 and FY 2028 chocolate revenue numbers very carefully. Flag 5, LOW. Shanghai subsidiary sold for 5 renminbi. Nominal consideration, disposal. Auditors reviewed it. Probably fine. But it's worth asking. Was the buyer connected to any related party? The green flag, OCF significantly exceeds net profit. $6.61 million operating cash flow versus $3.20 million net profit. The gap is explained by depreciation and working capital dynamics. It's normal and healthy for this type of business. This tells me the profits are real, not manufactured. Now the numbers we've all been waiting for. I ran 4 valuation methods and triangulated them. Method 1. Owner earnings, DCF. I used $6.1 million of normalized owner earnings. That's operating cash flow minus maintenance capex. I applied a 10.5% discount rate. That's the Singapore government bond yield, plus equity risk premium, plus a small cap illiquidity premium, plus a family governance premium. Base case DCF gives 21 cents per share. Method 2, EV/EBIT multiple. At 9x FY 2025 estimated EBIT of $4.1 million, that's a 25% discount to the peer median. I get $0.114 per share. Method 3, EV/FCF. At 8x owner earnings, conservative for a flat dividend microcap, $0.149 per share. Method 4, PE and P/book. 11x FI 2026 EPS plus 0.65x book value average, approximately 10 cents per share. Blended fair value, weighting DCF at 30%, multiples at 70%, approximately 15 cents per share. Why do I weight multiples more heavily? Because DCF is capturing the theoretical full cash flow potential of the business. But the business isn't actually distributing that cash. The dividend has been flat for 5 years. The multiples more accurately reflect what the market can actually realize when it exits the position. At the current price of $0.069, margin of safety is approximately 54%. That sounds great, and on a pure numbers basis it is. But here's the complication. I ran a reverse DCF. At $0.069 per share and a 10.5% discount rate, the market is pricing in about $2 million of owner earnings in perpetuity. The actual FY 2025 owner earnings are $6.1 million. The market is either saying FY 2025 margins are a fluke and will revert, or it's simply not paying attention to this tiny stock. That gap between $2 million priced and $6.1 million actual is your opportunity if the margins prove sustainable. Let me give you my final verdict under the JC Fund framework. 3 passes. Margin of safety of 40 to 54% versus blended fair value of 15 cents meets the 30% minimum. Near zero debt, $7.74 million cash, rising NAV per share to 11.91 cents. Best EPS and gross margin in 5+ years. 1 fail. The dividend has been flat at 0.20 cents for 5+ years. That's a 0% dividend CAGR. Engine A, which is dividend growth engine, requires greater than 5%. This is a gate failure. And 1 key risk. This is a $22 million market cap stock. You cannot build a meaningful position without moving the price yourself. The verdict is a pass, but needs to monitor. This is a quality business at a cheap price. But cheap price alone is not enough. I need a catalyst to close the gap between current price and fair value. Here's what I'm watching for. A dividend increase, even from 0.20 cents to 0.25 or 0.30 cents. This would confirm management is shifting towards shareholder returns and directly improves the Engine A score. The chocolate factory coming online and generating meaningful revenue in FY 2027. If the factory produces $2 to $4 million of incremental revenue by FY 2027-2028, the growth thesis is confirmed. FY 2026 gross margin staying above 25%. If the first half of FY 2026 shows gross margins holding, the SGD tailwind is proving structural. A price pullback below $0.050. At $0.050, the margin of safety would be 67% versus the multiples-based fair value, more than enough buffer for full position. If any of these catalysts materialize, I'll be revisiting this one for the JC Fund. If this breakdown gave you clarity on your own portfolio, share it with someone who needs to hear it. Drop a comment below with the one position you've been holding too long and why. I read every comment. And if you want the full JC Fund framework, the exact criteria I use to evaluate every position in the dividend and global growth portfolio, subscribe to JC Project Freedom on Substack. Link in the description. See you in the next one.